Welcome to the Page One Podcast, a podcast featuring a variety of guests and thought leaders on topics ranging from digital marketing, sales channel strategies, influencer marketing, best-in-class product launches, and all the details about how to accelerate sales. Now, here's your host, Luke Peters.
Thanks for joining us on the Page One Podcast. I'm your host, Luke Peters, CEO of Newer Appliances and Retail Band Digital Strategy Agency. We're now in a coronavirus world, and I know that's on everyone's mind. So I'm going to adapt all of the interviews to ensure that you listeners are getting the most out of this podcast. You can expect us to get right to the point. And quickly, business owners, how are your digital sales performing right now? I'm sure they're doing good, or hopefully they are. And if you do need some help, if you wish you had somebody to come up with a strategic plan and grow your online sales, that's what we do at Retail Band. If you want to learn more, just find me on LinkedIn or email me at luke@retailband.com. And in this episode, you're going to learn from Frank Kaufman on how to ensure that you properly get forgiven on your PPP loan. Yes, I am interviewing an accountant, and we're going to be talking about all of these accounting things. But right now, I know for business owners, this is, front and center. It's so important. PPP is huge. And we're also going to touch a little bit on M&A, financing, strategy implementation. So Frank is the retail national practice leader at Moss Adams and chairs the firm's Paycheck Protection Program Technical Resource Group. He has been serving clients in the retail and direct-to-consumer channel since 1983. Frank represents several hundred clients with years of experience in M&A, financing, reorganizations, and strategy implementation. And Frank, interestingly, is a graduate of Cal State University of Long Beach, just like myself. So Frank, I bet you didn't know that. We have something in common there. And great to have you here on the Page One Podcast.
Hey, Luke, great to be here. I didn't know you were a 49er or a beach person, but there's a lot of us out there. It's good to hear.
Yeah, and just so the audience knows, so Cal State University of Long Beach is, kind of a little bit south of Los Angeles, near the beach. And the funny thing is, during the COVID lockdown, so my daughter, she's not going to that school. She got accepted to a couple of other schools and is going to a different one. But anyways, we went over there just to check it out, and it's a beautiful campus to walk on. So it turned into like a fun day out because everybody's been on lockdown. This is like a month and a half ago, and there weren't too many people on campus, and we had a good time with the kids and stuff. But it's a beautiful campus. Cool that we have that in common. And Frank, you got a ton of experience, so thrilled to have you on the show, and thanks for making the time. Why don't we start with coronavirus and how it's impacted? Obviously, you're working with a lot of clients, and I know some it's impacted, positively and some negatively. But what are you seeing? Maybe a specific story would be interesting.
Yeah, so I will tell you a few things. One, just as you mentioned, most of our clients that are primarily digital-based commerce businesses have seen upticks, pretty substantial ones. In the ones that are sort of in the wholesale, retail, bricks and mortar, if you're an essential business, okay, you're doing well. If you don't fit in those buckets, it's survival right now, and it's very, very tough. And fortunately, the PPP funds are around. Interestingly enough, we had one client that started going down the path of a beauty business, and in March decided, the beauty factory can also make hand sanitizer. So they have completely exploded in the last April. I can't mention numbers, but insane numbers for April, May, and their backlog in the hand sanitizer business. So we all need that, and they feel like the new normal will keep that in play.
Yeah.
But so weird things come out of this world.
Well, those are the best stories. I had another guest, and her business, Words with Boards, and she transitioned into making face masks, during this pandemic, and because they have all the cutting equipment. So it's great when people can pivot. For those that can't pivot, and obviously, you guys, and by the way, actually, before I get to this question, Moss Adams, you guys are a huge firm. Do you want to quickly just give the audience a little bit on just size of the firm and geography and so on and so forth?
Sure. Moss Adams is about a 2,500 person firm, headquartered in Seattle, based primarily in the western half of the U.S. as far as our footprint, but we serve clients across not only the U.S., but internationally. And I think we're in the top dozen if you were to rank firms worldwide.
Great. Thanks for that. So you guys saying, for the audience, Frank's touched on so many different things but anyways, yeah, it's interesting when, clients are able to pivot, but not everybody is. So is there anything specific? Like obviously, companies that are hurting are going to have to do cost cutting, but have you seen anything or do you have any interesting stories on how folks have been able to do that or survive, besides just cost cutting? Are they, doing something with supply chain or with AP or, have they really just had to just go through the whole P&L and cut?
Yeah, there's a whole gamut of different things. You mentioned we've had probably at least a half a dozen of our apparel companies become, mask suppliers. And interestingly enough, they were turning lemons into lemonade. They, to some extent, all had old inventory. And let's say it's a T-shirt. A T-shirt probably wholesales for, I don't know, $5. A T-shirt can turn into 5 masks that wholesale for $4 each. There's not a lot of labor. So
oh, wow.
They took old inventory and quadrupled profits and at the same time delivering, something that all of us need. So that was pretty interesting and fun to watch.
That is pretty cool. So, why don't we get right into the PPP? So I know this is front and center on a lot of business owners. And, I guess we can start with, so what I want to really do is we're going to get into the value, which is let's make sure that the listeners here on the Page One podcast are getting as much forgiven as they legally can. And but before we get to that, there is some interesting history on this PPP. And you and I were just talking kind of before the show here and talking about the delay. And we had a slight delay in when we received our loan as well. And I think it was a couple weeks. And during March, it was a really dark time for pretty much every company because there was that time when the market just tanked and people didn't know what was going to be left in a couple of months with everything shutting down. And even though some companies are doing well now, it's still really uncertain in the future. But anyways, going back to that time frame, you mentioned why there was a delay. And if you don't mind quickly kind of sharing that with the audience and just starting off like how this PPP process kind of started.
Okay, sure. So first off, the CARES Act was passed on March 27th. And, I think it was 850 pages. And in there was the portion addressed called what we refer to as PPP, but the name is Paycheck Protection Program. And the name's important, I'll get to later. But the idea was that it was going to be an SBA loan and it was going to go through the banks and the SBA was going to guarantee 100%, which is different than their normal programs, which are about 85%. So the banks were getting real big pressure to get the money into the marketplace right away. But what most people don't understand is that the guarantee is good as long as the bank does their job. And their job typically is at least a 30-day diligence process to make sure the application is what it should be. And if, in fact, the bank messes up in that diligence process, the guarantee goes away and the bank is at risk. So the banks and the SBA were negotiating for about a week until the SBA said, okay, it's unfair for us to expect you to get money in the marketplace and do your normal diligence process. So you are off the hook as long as you're taking the information and it looks reasonable. You don't have to do the normal diligence. And that actually caused about a week delay in getting money into the hands of the public. But that one actually we're over now. But that was an interesting stress point at that time when people needed the money very quickly.
Yep, exactly. And so now kind of bringing it up to current times, some folks have received this money and, what's next? What should they be planning for? And I think on the surface, it seems pretty obvious on how we should handle the loan and to properly, use it like it was intended to. And then the percentages or calculations on how to get it forgiven. But I guess at this time and point, what's next and what should folks be thinking about?
Sure. Okay. So basically what happens is once you receive the money, the clock starts ticking for the next 8 weeks and it's looking at what dollars you're spending. And if you spend the correct dollars in the right amounts in the right bucket, there's a possibility that the entire loan will be forgiven. If it's not, know this, that the loan is, there's a 6-month moratorium. So from the date you receive the money, you wouldn't have to start paying anything back for 6 months. And then you have up to 2 years to pay it back. And it's a 1% interest. So the funds outside of the forgiveness part, they're still pretty darn competitive. But the idea really now is to understand the formula of how forgiveness works, the couple buckets things fall into, and the levers that you have at your disposal to pull to maximize the forgiveness. Because there's certainly a misconception out there. If I got PPP funds, it's all forgiven. That's not the case at all. So you need to be smart about where you're spending the money.
Okay, and also for the audience, just so you know, Frank was kind and thoughtful enough to prepare a deck. I'm going to include that. It's too much to talk about here on the podcast. It's going to be on the website, on the retailband.com website, probably as a blog, and we'll have this in the show notes as well, linking to it. So if you go to the Retail Band podcast page and you're on the show notes, we'll have a link as well. And I'll have portions of that deck on there showing you guys, because there's a lot more details than we can even explain, or than Frank is going to have time to explain here. And in true, accounting format, this thing's like 25 pages long or some crazy amount. So I went through some of it quickly, but I'll try to condense it and put it in there for the audience. So Frank, why don't we just, moving through this.
As of today, there's about 50 frequently asked questions and responses through the SBA in about 60 days. So when Luke puts that on there, I think it has today's date on there. Understand that there will be, not that there can't be, there will be changes post. So you need to you digest it now. That's fine. But you got to stay up to date because things are happening constantly in the interpretations of the law, both from the Senate, the Congress, the Treasury, and certainly the SBA.
Well, that's a great point. And actually, so before I get to the next question, there have been some folks that say, don't take this loan because it's not going to be forgiven and you can't trust the SBA and all this kind of stuff. I mean, there's a few prominent people that have said this that I've heard, but it does seem, I know there's been, some changes and fluctuations in how this thing has been rolled out, but should folks be confident that they can kind of trust the initial, as long as they follow the rules, that portion will be forgiven? What are your thoughts on that?
Yeah. So what happened, I think we're up to like frequently asked question number 48, but there was an infamous number 31 that came out and said something on the order of if you took money and you had other sources of liquidity, you should pay it back or you're going to be subject to criminal prosecution. And for about 2 weeks, it got really intense for people who are, wait a minute, I'm following the rules and now I'm a criminal. It was intense. There were subsequent, addressing of that. So now the deal is, for one, should you have taken the money? And the SBA came out and said, look, if your loan is less than $2 million, we are going to deem, by the fact that it's less than $2 million, that you are acting in good faith. Okay? Meaning not necessarily that you get to keep the money, not necessarily that it will be all forgiven, but the whole idea of criminal prosecution and all that other stuff isn't going to happen. If it's above $2 million, for sure you're going to get audited. And if upon audit, you're going to be deemed to have not taken that money appropriately. And if you give the money back at that point, you are also off the hook. Okay, so that's one big thing to understand, because there was a time where everybody was very, very concerned they shouldn't have taken money. Now, there are entities, some very highly publicized entities, a lot of public companies Harvard had taken money and they got a lot of criticism and gave the money back. The Los Angeles Lakers took money, gave money back. So there's a public, profile that you should be aware of. Every company that takes funds, the name of the company and the amount of the funds taken through this program are known. So if that has a negative impact to your organization, you may want to consider giving the dollars back. But assuming you're not in that ballpark, there's reasonable expectation, if you follow the rules, that you will be able, depending on your personal facts and circumstances, to get forgiveness. And I alluded to this thing before, PPP, Paycheck Protection Program. That means the government wanted the employers of the world, especially the fact that half of the employees in the U.S. work for small business. They didn't want, this ballooning of unemployment. So the idea was, we're going to give employers money, small businesses, and they're going to give it to their employees. And frankly, whether they work or they're furloughed. We still want them to give them the money. And that continues the paycheck protection. It's not about helping the company out. It's not about helping the company be more profitable. It was to continue for those people to receive funds. And so that's really the spirit, and that also defines kind of where you're supposed to spend the money.
Got it. And talking about that, I mean, I guess that can be where we go next, is how are folks allowed to spend these funds? I mean, it's from what I understand, you spend it on payroll, I think rent, I think insurance, and then there might be another category. Are those the main areas?
Yeah. So as you come to the forgiveness amount, there's two buckets. And the first bucket is where you're spending the dollars. And there's currently a rule, we talk about 75-25 rule, which says what's considered payroll, the amount that you spend on, quote, payroll will be at least 75% of your forgiveness. And payroll is defined as cash compensation. It also includes healthcare benefits, also includes 401k matching. So that's your basic payroll. And then there's another bucket, which is the 25% bucket. And the 25% bucket is generally rent and utilities and a couple other minor items that fall in the 25% bucket that is forgivable. The other item in there is mortgage interest. And then there are other pieces that fall in the 25% bucket that aren't forgivable. And we don't have to get into details, just know the rules get really complex.
Yeah. And speaking about that, so I think on a surface, most business owners kind of understand that basic 75-25. Okay, let's, follow the rules, make sure we document, and spend it for these things. But what are maybe three important things to consider, or a couple at least, that folks may not be thinking about? And these three things would ensure that the loan is, more of it is forgiven or all of it is forgiven. What might be those missing elements that are not so obvious on the surface?
Right. So what I talked about so far is the buckets of money where you can spend the money. But that just equates to what your maximum allowable forgiveness amount is. So let's just say you had a $500,000 loan and you spent $500,000 in the next 8 weeks in the right categories. Okay. That means you could get $500,000 forgiven. However, what you get forgiven is that maximum amount multiplied by a reduction percentage. And the reduction percentage is based on your head count of payroll over your 8-week period post-funding versus a couple base periods. So if oversimplifying, if you had $500,000 that you thought would be forgiven based on what you spend, but your number of full-time equivalents over the 8 weeks was half of what it had been in the prior period, you're only going to get $250,000 forgiven. So it's two pieces, and you have to know each piece and how you stand.
So just to clarify, even though in that example, were they actually spending $500 on payroll, but you're saying they're not going to be forgiven $500 because in a previous period, maybe their payroll was $1 million? Is that kind of what you're saying because the percentage of payroll has gone down, or?
No.
Okay.
It's dollars. So let me try to explain it, because and sometimes we do this visually because it's easier to understand. But let's assume for a minute, like you said, the first part, you spent $500,000. Your loan was $500,000 and you spent all of it in the appropriate categories. Not all of it has to be in payroll, but 75% is in payroll. The rest is in the other categories. So you spent $500,000. That's great. Okay. However, there is a separate calculation that's done that has nothing to do with dollars. It has to do with people headcount. Okay. So if you receive the funds on, let's say, April 15th, you got your money. You go the next 8 weeks, and during that period of 8 weeks, it's determined that you had full-time equivalents for that 8 weeks of 60 people. And then you looked at one of two base periods. One is the first 60 days of this year, and one is basically most of the first half of last year. Now, you compare, and let's say the lowered number there was 100. So your base period's 100, and you're only employing 60 during this window. That means you're only get 60% of the maximum dollars. So 60%.
Got it.
500. Now you are forgiven 300. The other 200 is now the loan that you have to pay back over the 2 years.
Okay. And no, that is actually kind of what I was thinking. So So that is, I guess, if folks kind of made cuts before the PPP and the folks that put this plan together wanted you to hold on to everybody. And so they're kind of comparing to an earlier, even if it was an earlier time frame this year. And is that based on, so it's not based on dollars, it's literally just based on number of full-time employees. It's just each employee, and you come up with a percentage of where you are now compared to what your employment quantity was, say, in a previous period. Is that how this formula is put together?
Yeah. So up until May 14th, everybody deemed that a full-time equivalent was somebody that worked at least 30 hours, because most of the other payroll laws, identify a full-time person as 30 hours or more.
Yep.
So the SBA came out and said, no, it's 40 hours. And so now everybody's recalculations of base periods and things has to change to 40 versus 30. There's a couple different ways that you can do that. One is for people that aren't 40 hours, you can assume they're all 0.5 full-time equivalent across the board, which in some cases that works if you have a lot of people in your workforce working, 12 to 20 hours a week. Other methodology means, let's say, if you have somebody working 32 hours a week on a 40-hour week, that's 0.8 of a person. So there's all different kinds of funny ways to, calculate or approach it. But some of the options, you select option A versus option B, it can seriously impact and help maximize your forgiveness amount.
Yeah, no, it's super, super interesting, by the way. And any other, because that could make a huge difference if people have staffed down, before and after, even if all of the funds are going into the 75-25 buckets, it could make a huge difference on what is forgiven. Anything else stand out like that folks may not be thinking about?
Well, absolutely. There's a couple safe harbor things that came out which are pretty interesting. One is if this applies to individuals that were furloughed between February 15th and April 30th. If you let people go and they're furloughed and you bring them back by June 30th, you hire somebody and they come back on June 29th, okay? And they're now an employee again for you. They count. There's not really much in the way of dollars that they've been paid, so the first bucket of dollars isn't going to change. However, they count as if they were an employee the whole period. So instead of losing a full-time equivalent, you have added that person back, and that's huge. And then even more interesting thing that's happened, as we know, one of the programs, the federal government is adding $600 a week to unemployment, state unemployment. So unfortunately, some companies are trying to hire people back and they're getting responses that are, well, you know what, when my unemployment runs out, maybe I'll come back. But right now, no, thank you. If you get that response, you document your offer, you document the response, you get to count them as if they came back, even though they never did.
So Frank, I've heard that exact situation happen, where people won't come back. So that is and I've never actually heard this explained that way. So that's really interesting information. I'm sure it affects a lot of service businesses. I heard it's happening a lot with like salons and other businesses where the unemployment payments were kind of competing with what folks were making in those jobs.
Yeah. The one other thing I'll mention is that if that occurs, I believe it's 30 days that the employer has to notify the SBA, not the SBA, but the unemployment agencies that you have offered them a job. Because as you might imagine, the unemployment agencies aren't real happy about this concept of you offered your job back and they say, no, I'm just going to take money and not work. So there's some burden on the employer to communicate that, and there's kind of a notice on behalf of the employee that they need to be careful about their choices.
Makes sense. And then I guess similar question, but maybe on the same theme. But are there common mistakes that borrowers are making that might hurt them if they don't have second set of eyes looking at this?
Yeah, there's probably the most common area is there is a cap to the dollars around payroll on an annual basis that is over $100,000. So, if you are receiving funds above that, you need to make sure that you only counting the funds in the 8-week period. I think the number is something like $15,385 is the maximum per person. You also need to be careful because if you pay out bonuses in a 2-week window there, that can skew the numbers to make somebody look like they're getting more than 100,000. So there's a lot of tricky rules, so to speak. So my suggestion is either get with somebody that spent a lot of time, with a team doing that, or spend a lot of time yourself. The SBA form, the forgiveness form to apply for forgiveness, is a 2-page form with 9 pages of explanation. So that might tell you that it's a little confusing.
Yeah, exactly. And for most business owners, that's generally not the best reading for us. Not our area of expertise. That's funny.
One other thing I should point out, Luke,
Yep.
and I don't know if people are, but it's a big deal. If in fact you haven't applied for the funds at this point, feel free to go ahead and do so. The first chunk was $349 billion, and it disappeared inside of, I don't know, maybe a week. The second chunk of $310 billion, about half of that, I think there's $147 billion as of yesterday still available. You have till June 30th to get after those dollars. So if you haven't applied, go get the money if it fits you, because it's, like I said, good shot that you could be forgiven, and even if not, pretty low interest money.
Well, that is huge news right there, because, and we were talking previously about a business that was rejected on the loan for, no good reason, probably just a paperwork issue. So, any folks out there listening who haven't gotten it and really need it, good news that you got plenty of funds left. So, Frank, just in the intro, we talked about that we would kind of jump into a couple of other areas, and I'm sure, you have tons of experience in M&A and a few other things, but what are, uncommon ways, but maybe the best ways that companies can increase their liquidity right now during this crisis? I know liquidity, anybody who's working with a bank, liquidity is front and center on businesses' minds and also on their bankers' minds. And, obviously, there's a lot of things companies are doing with AP, or just trying to get more profitable or increase liquidity, maybe by, leaning out inventory or one way or another. But has anything else kind of come to mind, or a crafty way that companies are improving their liquidity right now?
Yeah, there are. But before I move completely off of the PPP, because there's something here that helps in that question as well.
Sure.
So, the banks that are doing this, in one respect, are happy because it's not a risk to them, because they're going to get paid if, God forbid, the company defaults. But as you know, when you're applying for the PPP funds, you went to your existing bank, and that was because you got this Know Your Customer program that they wanted to go through before they give money out. It's very important. So odds are you already have a loan at that bank. And so if, in fact, the loan is going to get forgiven, and you can demonstrate to the bank why that's the case, basically that money, and there is a tax impact, but that money net of tax becomes like an equity contribution to your business. And so your bank covenants are easier to meet, your leverage is easier to meet, and that may allow you to get more leverage out of your existing bank, just knowing that. So that's within the PPP program.
That's a big deal, by the way. Before you go on, because like I've heard it both ways, and some banks are not interested in counting that yet, until it's forgiven. So what's the key differentiator there? Or is it just kind of dependent on the bank?
Right. So first of all, to probably expand a little bit on the forgiveness process. 8 weeks, and then the company has actually up to 4 months to apply for forgiveness. And then the bank has 2 months to determine whether or not they think you should be forgiven. And then if they think it's forgiven, then it gets submitted to the SBA. And there's another 3 months.
Oh, wow.
So if you think about it, 2 months, 4 months, 2 months, 3 months, it's an 11-month process.
Yeah.
If you can share with the bank your calculations and your analysis, it's helpful for them when, in fact, the forgiveness, the actual notification could come almost a year out. So that's important to know. And the bankers are dealing with a full range of customers. Some that think, well, I got the money, so it's forgiven, and some that are very astute on the rules. And so if you put yourself in the second bucket of being able to communicate to them, it will help you with your existing bank.
Great advice. Okay, cool. Thanks for that. So I guess from there, we were talking about improving liquidity, and it goes hand in hand with these times. It's more about COVID and companies struggling and having to really make sure they're going to survive. survive. And to survive, you got to have liquidity. And just your thoughts on, what are maybe unusual or different ways, or any stories you have on how companies have improved their liquidity position.
Yeah, so I would say if you're, let's say you're bricks and mortar retail, right? You may be completely shut down, hoping to open up soon. In decades before, unfortunately, I was the accountant for several creditors committees when people were trying to restructure, and the only way you could restructure your leases was going through a Chapter 11 process where you're a little more in control. Today, the world's different, and so there's a lot of communication directly with the REIT, the landlords, as far as what they're willing to do. Most are willing to enter into some kind of agreement where it's not rent forgiveness, but it's deferral, which at least in the interim is helpful. But when you're negotiating your rents, you're probably feeling you're paying as much as you can pay. If in the coming months you have to pay that plus making up the gap that you've deferred, it's going to be tough. So, but there is, I guess I'll say, a lot more informal reorganizations going on the rent side. On the supply side, boy, it is working with your vendors and trying to get them money, trying to be communicative about how your business is going. I mean, if you are a digital business and your volume is up, 20%, and you're buying more from them, they're going to have a hard time if you say, "Hey, I need a payment deferral." I don't think that's realistic. But if it's the other way around, you're working with them and like, "Look, you got product in the supply chain that I haven't even taken yet. If we work this together, we'll find a way over time to work all that stuff through." Maybe we're not, I guess I'll say there's more carryover product for companies that tend to be very seasonal. They're trying to find a way to carry product to the next year and help everybody out.
Great for that. Thanks for that. And, you're also, have a lot of background in M&A, and that's always an interesting topic and valuable for the audience here. And I guess what I wanted to ask you is, also you're involved in company audits and making sure that the books are correct and helping companies with their accounting practices. So kind of combining those two, what are things that companies can do to make sure that they appeal more to an investor, for an M&A transaction, and kind of looking at it like, obviously, they want to increase their profitability and things like that. But is there anything else that stands out? Could be something on the balance sheet or just, or even something that's specific to these times in COVID that makes a company more attractive.
Well, I think there's a general perception. If you look at the retail sales mix, you're talking about somewhere around 12% is the direct to consumer, the digital economy. I've heard estimates of anywhere from 18 to 25% is what the new norm's going to be. It's just a more efficient model, and there's going to be, a lot of challenges in the bricks and mortar. So I think one of the big shifts is going to understand that you're going to be moving. A lot more business is going to be done that way. So with respect to the buyers, they're going to look, and if you're in that bucket, they're going to assume whatever you're doing today, other than the in-between blip, but long term, you're going to be in a higher growth curve than you ever have been. This is going to expedite the process. So that's one real big plus. One challenge is the bank in general are, in my opinion, going into what I'll say the most conservative lending arena. Most of the credit committees are worried about the losses that they're going to incur. And so they're not going to be putting the dollars out into the market that they would normally do. What that means is most private equity acquirers are not going to be getting the same leverage that they would like to, or they have. If they put in $1, maybe they can get $2 from the bank. Well, maybe now if they put in $1, they might get 75 cents from the bank, which is going to have downward pressure on purchase price. So it should be you should be considering that if you're looking at sort of liquidity events, going to have a big impact.
Wow, that's super great insight right there, and something that I would have never come up with. And And of course, we're thinking, I mean, there's a great point on the digital sales side. And obviously those companies are kind of better suited for the future. And in a way, almost kind of like, I mean, it's not the same multiples, but kind of like, you want to have a SaaS component of a business if you can, because those multiples are amazing. And now it's kind of like the mini SaaS, I'll call it, is like if you have a direct to consumer component of the business. So good insight there. But the other one was really interesting. So does that mean that that something that could come out of this over the next couple of years is that there's still a lot of dry powder on the sidelines looking for these investments, but you're saying that the number of investments may decrease, or maybe it's just more that there's going to be pressure on the multiples on a go forward?
Yeah. So what I think, when businesses transact at very high values, it's because you're significantly different than the rest of the marketplace. And the story is there's at least a 3 to 5 year window where that's going to continue. And so I do think that people are faring well through that. I mean, in the past, I can't ever remember in any kind of deal, let's say Moss Adams Capital was putting together. In the book, did we put the term our distribution channel are essential businesses? Okay, and so now that's going to be one of the things that gets checked. It's like, okay, well, God forbid something happens and we go into this process again. If you're not direct to the consumer, all right, are you selling to Walmart and Target? If you are, wow, your business is going to pick up. If you're selling to, call it, mom and pop boutiques, I don't know what's going to happen. So that's another kind of caveat. The other thing we're seeing, which is interesting, that goes back to this PPP loan, because some of these loans are $10 million. And if you are in the middle of transacting this loan or this transaction and you have a $10 million PPP loan that might take 11 months to figure out if you're going to forgive or you're not, there's a big contingency, escrow, or question around purchase price. So that's another reason why you want to kind of go through this analysis. But it's it'll be interesting. I think there were more dollars in the marketplace than companies that were being able to be transacted, and now it's even more so the case. So it's going to be pretty interesting on the M&A. Currently, right now, deals that are closing are ones that are already like 95% down the road and don't have a significant impact from coronavirus or that had an uptick. Or there's bottom fishers out there that are trying to take advantage of, people are in tough times. And so unfortunately, some businesses are falling by the wayside, in those scenarios.
Makes a lot of sense. And we've talked about a lot of different things here, gone deep into PPP and hope to finish it up on this question. And you've been a great resource so far. So kind of on the same note as PPP, but besides that, I mean, there's other programs. I've heard of some smaller SBA programs. I think one of them was like a $10,000 loan, but it was, it had to be or required some sort of other guarantees that didn't seem as interesting. But beyond that, what other government programs should business owners keep an eye out for?
Yeah, so there's a few things. I think the $10,000 thing might have been the EIDL, which was the Economic Injury Disaster Loans, which could have been more, and everybody who applied would get maybe $10,000 that was forgiven. And frankly, even if you applied for $1 million, I don't know of anybody that's got more than the $10,000, and that was actually started before PPP. So at this point, that if you're in the agriculture business, you can ask for that money. Otherwise, never mind. With respect to, I'm seeing some people go to commercial lenders, not the traditional banks, and there's a higher interest cost, but sometimes the liquidity is what you're looking for. There are some programs. One of them, or a couple of them actually, if you didn't do the PPP loan, there's something called an employee retention tax credit, and you can get up to $5,000 per person, which is based on 50% of their salary. For everybody that you employ, it's a tax credit that you can get. Another thing that you can do, whether you have the PPP or not, is you can defer the FICA portion of the employers. So if you're making deposits on payroll tax, you're the employer, the part that you put in for FICA, you can stop depositing that. And through the end of 12/31/2020, and whatever that amount is, you would pay half of it at the end of 2021 and half of it at the end of 2022. The only caveat is that deferral of money stops if you get the formal notice that you've been forgiven on the PPP. So it doesn't mean you have to pay it back then. You still pay it at the end of 2021 and 2022. But that weighs into some people's decisions as to whether they're going to apply right away on the 8-week and first day, or they're going to wait 120 days before they apply.
Cool. So much to digest here. And it's great that it's podcast format. So you guys can all rewind and hear those last couple bits again. And of course, we'll have show notes. I'm going to have Frank's deck. We'll have that on the website. And then Frank, I'm sure listeners might be interested in contacting you or learning more about how you can help them. What's the best way to get a hold of you?
So very, very easy. Frank.Kaufman, Kaufman at MossAdams.com. Or if you just can remember MossAdams.com and you look under retail, you'll see me. And I have no problem. My cell phone is how I live. That's 949-933-9646. And happy to help with any of Luke's listeners.
Well, thanks again for that, Frank. We'll have all that in the show notes. And I just want to thank you again for being a guest here on the Page One podcast and sharing your valuable knowledge with their audience. And really hope everybody benefited from that. And thanks everybody for listening to this episode of the Page One podcast sponsored by Retail Band. Hope you enjoyed the interview today. Truly appreciate your reviews on iTunes and hope you join us for the next interview.
Thanks for listening to the Page One podcast with Luke Peters. If you enjoyed this episode, please help us out by leaving us a rating on iTunes. Want to double your online sales? Check out www.retailband.com. And don't forget to join us next week with our next amazing guest.